In my last video, I talked about how a new tax ruling in 2024 by the IRS essentially reduced the power of Roth contributions for self-employed individuals when we're talking about SEP IRA contributions and also the employer portion of solo 401k contributions. If you haven't watched that video, I'd encourage you to do so first. It's only 90 seconds and it's linked in the comments. And before we dive into how to potentially sidestep this new tax ruling, I think it's important to highlight some major differences between a SEP IRA and a solo 401k. So as a self-employed individual or anybody with 1099 income for that matter, the IRS generally will view you as two parties wearing two different hats. The first is you as an employee wearing your employee hat, and the second is you as an employer wearing your employer hat. This is why self-employment taxes exist really. You pay Social Security and Medicare taxes as an employee, just like you would if you worked for somebody else. But when you're self-employed, you have to pay Social Security and Medicare taxes as an employer too, just like any other employer does, and that's the self-employment tax. Now for SEP IRAs, it's interesting, the IRS only views contributions as coming from the employer or when you're wearing the employer hat. So there's no such thing as an employee contribution within a SEP IRA. But for a solo 401k, you can potentially contribute as both an employee and as an employer. Now, if you have a W-2 job or multiple jobs that are supplementing your 1099 income or self-employment income, you have to be aware of several different thresholds and limits, but that's beyond the scope of today's video. For today's video, we've got a sample married couple who earns $350,000 per year on a pre-tax basis. We'll say the husband earns $150,000 as a W-2, and then we'll say the wife earns $200,000 in business profit from her self-employment. So in today's video, we'll focus on the wife's $200,000 of business profit and how she can maximize her contributions to a self-employed retirement plan, both through looking at different combinations of SEP IRA transactions or contributions and also a solo 401k. So like I mentioned before, in 2025, the contribution limit for SEP IRAs and solo 401ks is $70,000. However, because the employee and employer options are available within the solo 401k, generally speaking, you don't have to have as much profit to be able to contribute the full 70,000. So at a level of 200,000, a solo 401k, you could do the full $70,000 that you're, the maximum. Whereas with a SEP IRA, the maximum you could do at 200,000 of business profit is around $47,000 for the year. Again, that's because a SEP IRAs, you have only the employer option, whereas solo 401k of employee-employer. Now, the contribution tax types are also different between SEP IRAs and solo 401ks. For a SEP IRA, you've got your pre-tax or your traditional contributions, and you've got Roth. We'll talk about it in a little bit, but a solo 401k is a third one called an after-tax or a non-deductible contribution that it has available, the SEP doesn't. So let's start with the SEP IRA and looking at a couple different scenarios. Number one, do nothing. Number two, a pre-tax or traditional contribution. And number three, a Roth contribution. And then compare that to how we could use an after-tax non-deductible contribution on a solo 401k and compare what the taxable income is on the business profit and how much they were able to get into a tax-advantaged retirement account. So with the do nothing, again, the business profit was 200. We're saying $0 of a contribution. So her qualified business income, now that term comes from a 2017 law passed in 2017 as part of the Tax Cuts and Jobs Act, where essentially you can exclude 20% of your business profits from tax each year. You have to be under certain thresholds. If you're married, it's around $425,000 of gross household income. And if you're single, it's around $210,000 in 2025. So this couple at 350, they're not phased out of the QBI 20% exclusion. So they get to take the full 200 in business profit times 20% and reduce that business profit by $40,000. So really their net taxable income after that deduction is 160,000, the 200 minus the 40. So that's kind of our level set. Their taxable income is 160 and their QBI deduction is 40. Now, if we look at they're maxing out their traditional SEP IRA contribution and they put in 47,000 on a pre-tax basis, their QBI, qualified business income, would be reduced because this is a pre-tax contribution. It reduces your qualified business income. So accordingly, 20% of a lower number gives you a lower QBI deduction, only about 30,600. So your taxable income on business profits of 200 when making a $47,000 pre-tax SEP IRA contribution would be 122,400. Now, what's interesting about this, comparing that to the original scenario, is the difference in the taxable income on the business profits is a difference of 37,600. But really, you made a $47,000, what should have been a $47,000 deductible contribution. But because you also reduced your QBI deduction, you only got 80% of this actual deduction to use on this year's taxes. Whereas when you withdraw this 47,000 out in retirement, you're going to have to pay 100%. You're going to have to pay tax on 100% of this 47 grand. So again, under QBI, even making pre-tax contributions really limits your deduction. You're only getting a deduction for 80%, even though you're going to be taxed on 100% when you withdraw it in retirement. Now, Roth is even worse, quite honestly. So same scenario, business profit 200, but instead of making a pre-tax contribution, you make a Roth employer contribution of the full amount, 47,000. That new IRS ruling in 2024 says that based on how taxpayers have to report the transaction, Roth contributions now reduce QBI eligibility, even though they don't reduce your taxable income. So kind of the worst of both worlds. So your QBI is the same as the pre-tax 153. Your QBI deduction is less, only 20% of the 153. And then you have to add back the $47,000 Roth contribution because you're paying taxes on it now so that you won't pay tax on it later. So you have to add it back. So really your taxable income on your business profit is 169,400. So if we compare that to the original do nothing scenario, the taxable income was 160. Now, by making a Roth contribution here, you increased the amount of your business profit that you're going to be taxed on by $9,400 because this Roth contribution now lowers your eligibility for that 20% QBI deduction on your business profits. So, not to say that Roth is bad, but under these new rules, you've really got to understand what you're doing when you're making a Roth contribution and how that makes you actually pay more taxes on your business profits in this tax year. Now let's contrast that with a solo 401k. And instead of a pre-tax or a Roth contribution, we'll leverage an after-tax or non-deductible contribution. This is how backdoor Roth IRA conversions work, is through this after-tax or non-deductible mechanism. You make a non-deductible IRA contribution to a pre-tax or traditional IRA, but because you don't get a deduction for it, that means you've already paid taxes on it. So therefore you can convert it tax-free to a Roth IRA. There's no income limits currently on conversions to Roth IRAs, which is why the backdoor Roth is legal. But there are income limits on Roth contributions, which is why you have to do the backdoor Roth IRA method in the first place. So kind of that same structure is what you can use through a solo 401k because it has after-tax or non-deductible contribution eligibility. The other great thing about after-tax is you're not subject to kind of the same percentages that you would be on a SEP or even a traditional employer contribution with a solo 401k. After tax is considered an employee contribution. So for a SEP or a solo on the employer contribution, you're limited to around 20% of your business profit to be able to put in. Whereas with the after tax, you can put in 100% of your business profit. You're not subject to the 20% amount. You can put in 100% of your net business profit as a contribution. So in this example, 200,000 was the business profit. So we can very easily make a contribution of 70,000 as an employee contribution via after tax to the solo 401k. The after tax solo 401k contribution does not reduce QBI like the Roth does. That's the big distinction. So again, your QBI, your deduction is going to be much bigger with the after tax because you're not reducing your qualified business income because you're not making a Roth contribution. So you get the full $40,000 deduction, whereas on both a pre-tax SEP or a Roth, you only get a $30,600 deduction. Again, the conversion from an after-tax solo 401k to either a Roth solo 401k or even a Roth IRA is tax-free because it was non-deductible in the first place. You didn't get a deduction for it. You already paid tax on those dollars, so you can convert it tax-free just like a backdoor Roth IRA. So our taxable income after taking into account this $40,000 QBI deduction is 160, which is the exact same as the do nothing, except you were able to stash away $70,000 indirectly into a Roth type account where all future growth and when you take it out will be tax-free. The other interesting point is compare that to the Roth contribution for the SEP IRA scenario. Your taxable income on your 200,000 of business profit is less through the after-tax contribution than it is if you do a Roth through a SEP IRA. Again, it's because you're not taking a hit on that QBI deduction. So actually, your taxable income is lower by $9,400 by utilizing this after-tax contribution in the solo 401k. Yet you got $23,000 more into Roth. You were able to contribute 70 here, whereas you were only able to contribute 47 over here. So you got double tax advantage savings there because you lowered your taxable income by 9,400 relative to the Roth option, and you got $23,000 more into a Roth type account through utilizing an after-tax contribution through a solo 401k. So my hope is, this is definitely complex, but my hope is you found this content informative and meaningful. And if you want to stay updated on future content, please feel free to subscribe to my page. And if you're a high earning solopreneur in their 30s or 40s that wants to partner with somebody who can help you maximize the full potential of the resources you have, feel free to check out my website at truerichesfp.com and book a complimentary 60-minute discovery meeting.